So Strix has been able to actually see some growth finally in the cattle market during 2023. The market's been quite mixed. Yeah, we've seen some positive growth in the second half of the year in the less regulated market and in China, and that really was quite like the historic norms. However, the regulated market is still quite slow. It is improving from the second half of the year. After 9 quarters of negative growth, it actually has turned positive, and we are now seeing quarter-on-quarter growth, which means actually on our forecast going out, we have reset the forecast to reflect that slower recovery in the regulated market. Looking forward, there's still quite a lot of things going on in the cattle segment as well. Yeah, we are bringing out the next generations of controls, the Series Z. Yeah, this is very important for us. It allows us to get into different adjacent markets with a unique control, quite revolutionary, using less commodity materials, lower cost and a higher specification. And we're also looking to bring in a low cost control that will increase our addressable market, really trying to improve our position in China and the less regulated, both from a volume perspective, but also from a margin perspective as well. The Billi acquisition has been a tremendous success. It really has done exactly what we expected. We've seen double-digit growth both in the bottom line and in the top line through what has been quite a challenging year. Not only have they exited from all of the TSAs, but they've also managed to introduce new products with the Omni One product and also the LuxGuard product in Australia, and they will gradually get expanded into the export markets as well. Billi continues to be a significant growth opportunity for us going forward. A lot of work being done to expand into additional markets, particularly into Europe, which is really an untapped, market for Billi. But also we're looking to leverage off the Strix technologies, the heating technologies in particular, whereby we have some quite specialised new technologies, patented technologies we can put into those products to further differentiate them from the competition and also improve the sustainability and the cost of those products as well.
I think one of the fundamental things about the company that appealed to me is that you've got right at the core of this thing, there is just a wonderfully profitable core business that sits as a foundation to the entire group. And it's a business that generates eye-watering margins, particularly in the regulated kettle controls market. And it's a business that then takes those margins and converts them very convincingly into cash. And that's a great foundation for any group and any business to have at its centre. I think that's one thing. I think what actually then makes it exciting is the acquisitions that the group have done over the last few years. So the acquisition of Leica, which has put a new addressable market in place for the group into consumer goods, into that small domestic appliance space. And I think it's then the very good acquisition that was done into Billi. Terrible timing, but a very, very good acquisition into the group at the end of 2022. Those two things together now almost hit the magic sweet spot, where you've got a group that can generate profits and cash, and you have an opportunity to actually expand around that and to use that cash generation to then drive growth and to drive capital growth going forward. So for me, this is a challenging time to join the group. It would be disingenuous to not say otherwise. But by the same token, it is also an incredibly exciting future in the medium term. And I joined with that very much in mind and how I would be able to work with Mark and with the rest of the team to ensure that we make the most of the opportunities in front of us. There's one main reason for that, folks, and that really is just it will accelerate the speed at which the group can deleverage. The group is where it is, and we absolutely do need to get the strength back into the balance sheet. We have to have that foundation, that secure foundation behind the business. We have to deleverage because it will bring interest costs down, and we have to get ourselves back into a position where we're able to comfortably and flexibly invest in the future again. One of the ways we can do that is to look at the dividend and to call a temporary pause. What we're also going to do is, and we've stated 2 very clear aims here in our capital allocation policy, is that we are first and foremost going to get down to a target leverage of around 1.5 times. And we expect to be able to do that by the end of 2025. After that, we as a board have decided that the leverage appetite that we have is between the ranges of 1 to 2 times going forward. And we will make capital allocation decisions on the back of that particular policy choice. We are in a position of strength in the sense that we sit here at the 31st of December 2023 with a net debt leverage that operates within our covenants at 2.19 times against a max covenant of 2.25 times. But I've been working with the banks, with Mark's help as well, proactively to ensure that those particular existing facilities are more fit for purpose and offer a greater degree of security and flexibility as we move forward. One of the things we have been able to secure with the banks, with their support and their ongoing confidence, is a reset, a normalisation of that net debt leverage to something that you would normally expect to see in a group of this size. And so from now on, from the 31st of March 2024 up until the end of the facilities, covenants will reset to 2.75 times for the course of the facility. And we did talk about a pause in dividends, but it is a temporary pause. It's very much a temporary pause, and reflecting the confidence that both Mark, myself and the rest of the board have in this business going forward. We fully intend after the calendar year 2024 to return to a sustainable dividend policy of 30% of adjusted profit after tax. We're in a very strong position at the end of 2023, and we saw an 80 basis points increase in our gross margin. And that really, more than anything else, reflected the positive impact that Billi has had coming on board with its first full year of trading. Billi, and therefore Premium Filtration Systems Division, PFS, actually achieved the highest gross margin of the whole group. And by coming into the consolidation, that alone has allowed us as a group to increase our gross margins overall. I think there is a difference as we move forward. Billi will continue to have a positive impact on the group's margins as the regulated market in the kettle controls continues to come back, albeit more slowly than we originally anticipated. That will also have a positive impact on our gross margins. But there is a reality to what happens over the next 12, 24-month period. The group is looking at different ways of increasing its accessible markets. And in the number of those ways, we will be looking at opportunities which absolutely do bring pound notes into the gross profit line, but they do that at a lower overall gross margin. Things that Mark has already spoken about lower cost kettle controls, about some of the work that we're doing manufacturing on the consumer goods side for some of our big OEM customers. These things will reduce our gross margin on those particular sales, and as they increase in importance for the whole group, we will start to see that impact on the overall gross margin. Are we ever going to get to something that is a poor gross margin? Absolutely not. But what we do see over the next 12, 24-month period is a gross margin that's around the 35 to 36% mark by the time things settle. That's still very credible, and there's a lot of businesses will give their eye teeth to have that. But I do understand for Strix that it is a reduction from what has been seen in the past.
Yes, I believe we are in a very strong position going into 2024, 2025. Clearly, we have done some restructuring, we've rebased the business, and that's very important to make sure we've got all the right things in place to go forward. If I look at the individual divisions just very briefly, from a kettle's perspective, we've got the new low-cost control coming out, which will give us increased addressable market, and we've got the Series Z, the revolutionary product that will actually allow us to go into adjacent markets as well. So very positive there. Obviously, we need the regulated markets to recover, which will come in time, and we've been very conservative about the forecast for that going forward. With Billi, it really is continue as planned. Double-digit growth, top line and bottom line, using and leveraging off the Strix technology, expanding into Europe and eventually into the USA as well. All of those things are planned, and we have the right people and the right strategies to be able to achieve those over the coming years. So again, very optimistic with Billi. And on consumer goods, that has been a challenge over the last couple of years. However, I do think we're starting to get the right structure in place. We've rationalized the product ranges already to make sure that we're focusing on those profitable products. We have the right people, and we're leveraging off the manufacturing facility in Leica, which has been very profitable and very successful. So going forward, you're going to see more emphasis on the Leica brand. You're going to see us starting to actually bring in additional products, also starting to do some more manufacturing of our own in our own China factory as well, and making sure that we are as efficient as possible, focusing on the sustainability messaging that's been very strong within Strix throughout our growth.